Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Welcome back to another episode of the Real Estate Investing Club. This is the solo Wednesday episode that we record here. It is actually a little bit overcast here in Seattle, which I guess is for the course. We expect overcast, but it is July and it's been super hot. So I am happy to have the clouds. I'll tell you that. It's a good day though, because we have Dan French with us on the podcast from ATX Acquisitions. Dan has tons of experience in real estate, over 2 billion AUM. So a lot to go into here, a lot of experience. Dan, thank you very much for hopping on the show.
Gabe, thanks for having me. I'm pumped to be on, man.
Absolutely. I told you right before we got on here, we always like starting with stories and hearing how people got to where they are. Sounds like you got a good story behind you. So why don't you tell us, how'd you get here?
Yes, I've been in real estate for over 20 years, and the way I got involved was through a small partnership, and someone who I'm still in partnership with today. I'm very blessed to be able to say that it's been over a 20-year partnership. But I come from a working class background, and my why behind real estate back then, all the way. So I was around 23 years old. This is around 2004, and my why was like I was called into public service. That's how I felt. After 9/11, I became an elected official in my hometown. That was part of my response to what was going on at that time. Some of my friends went into the military. That's what I did. And I knew, I wasn't going to make a lot of money doing that. Right. So the only people who make money in politics are like crooked politicians. And that's not me, man. And, so I knew I wanted to have a big family. So one day, how am I going to create some wealth for the future? And that's why real estate really struck a chord with me. Also being a recent college grad, I lived in apartments, and I was like, I'm not getting a lot for my dollar here. And I think I could do this better. People famously in these like college apartments, or sometimes people call them college ghettos, they're not really doing much, right? It's just a dilapidated building. They're just cash flowing. And I was like, man, if I have a chance one day to do this, I think I could do it a lot better and treat people better. So that was my why, man. And so we started buying, the 2-unit type buildings, 4-unit buildings in 04, 05, 06, and felt really smart for a while. The sort of the mentality I had, and I don't think Pete maybe had this for my partner, but it was like kind of this infomercial idea of like, real estate is just up and to the right. You got to get in right now today. If you don't, it's FOMO, you're going to miss out. And I got wrapped into that. And then the great financial crisis hit us. We were kind of the poster children for, what not to do. And that means like no capital reserves, didn't know how to operate well, and over leveraged. So we fought through all that, and I'm going to pause there. But that was my why and how I got involved.
Yeah, no, I love it. I mean, I never like hearing people, going through hard times, but I feel like that really does set up your career for future success. If you kind of hit the rough patch, sounds like you did in the 2008 crash, and then you come back on the other side, you have those, those bruises in the face. You understand what real estate is and what it's not. And it's so difficult to not fall prey to the FOMO mentality, to feeling like you're, all the deals are being taken up, and so I have to close on this next deal. But that's not the right mentality to have, especially in real estate. Stick to your underwriting, stick to the numbers, and if it works out, it works out. If it doesn't, have the balls to just walk away from the table and say, this is not the deal for me. So you mentioned a lot of things. You mentioned you got started in the small multi, and since then you've graduated to multifamily complexes. How did you go from the small piece, and kind of take us through the 2008 period? You mentioned you were over leveraged. You didn't have capital on the sidelines to kind of weather the storm. What were the big lessons you pulled from that experience?
There's many. I mean, real estate is a very much a financial asset, and we're seeing that now, right? 2/3 of the capital stack typically is debt, and even that right now in today's environment is putting equity capital at risk. So even if you have 30% equity capital in a deal, if the pricing has gone down 30%, well, equity is wiped out, you know? So, but at least the banks aren't experiencing a meltdown because they're covered. At least their 65 to 70% is of value is still in the deal. So, and they have an asset that's backing that up. Obviously, they can just take it over. And we're seeing a little bit of that foreclosures like Tides and whatever other groups in the multifamily space. Clearly, office is experiencing this as well. But back in the day, when you can get 85 to 95% leverage, well, guess what? Everyone's wiped out. The equity's not there, and the bank is in trouble. So back then, the balance sheet of the banks were in complete meltdown, and that's why it's different from between today. In my opinion, the GFC was different magnitude of meltdown. And let's take office out of this. I think that's its own special, really brutal case. I'm not in.
It's almost a cultural shift that had the impact on
Yes.
office versus anything else. Yeah.
100%. Yeah. With remote work. But yeah, so my lesson there is like, hey, you have to be downside protected. So if I can say one thing, the big lesson, and this is why I like real estate people respect people with some gray hair, if you will. And some of my hair is going a little bit more gray, but it's good to be through cycles because then you can see these things play out. But the key thing is be downside protected.
Yeah.
And so never again would I take that kind of leverage. Never again would I, not have the ability and wherewithal that if something happened temporarily or even for a long period to be able to, weather the storm, have some capital on the sidelines and just be able to sleep well at night. That's what I want to do. I want to sleep like a baby at night, and I want my anyone who's partnered with me to do the same, especially investors, right? No one wants a call that things are in meltdown. They just want to call and say, here's my money, here's my distributions, or here's a refi, here's a sale, here's what we did. So that's my key lessons. Like downside protection is everything in real estate.
Yeah. Yeah. You always want the upside. You're looking at the upside when you're underwriting the deal. But I do feel like the most important thing to take into consideration or to kind of orient yourself towards is not losing money. That's at least what I underwrite towards. So long as we really cannot lose money in this deal, then it's a good deal for me. Since you went through 2008, do you kind of have an LTV or debt service coverage ratio that you guys track towards, or that you guys kind of have a minimum of, or what kind of KPI can you give us for your underwriting that kind of protect the downside?
Well, most of what we do now, and to your point, we starting in 2011, I joined Pete, my partner, right? He's the founder of the firm that did a couple $2 billion in assets, and this was about 17,000 apartments. So buying in Florida and Texas, coming out of the GFC, now on the other side of the GFC, right after the meltdown, the distress has happened. That's when we got greedy on this like second play that we did. And I was like so blessed to be a part of all that. It was really fun to scale out a vertically integrated team. So we built up, all the property management, construction management, acquisitions, debt placement, the whole thing, capital raising. Really fun company to build and have a great ride with. But to answer your question about like how do we look at debt nowadays? I mean, some of it is kind of answered for you. Like we do agency debt primarily, Freddie and Fannie, and they just won't let you
go any higher than 60%.
Yeah, trip the DSCR coverage, which is debt service coverage ratio. So they want to see that your business plan over the 5-year hold, at least in the term of their loan, is going to be robust and downside protected. So that it's almost like they've taken some of the riskiness out of, and that's why maybe that's why we're not seeing such a gigantic meltdown as we did in the GFC, because things with the changes in how especially the agencies underwrite deals. But so we would look for well above 1.25 debt service coverage ratio, because what if your rehab program doesn't work and your revenue is not as high? Well, you want your debt service coverage ratio to be more like 2x.
Yeah.
And that feels pretty good. And then, not going above 65% LTV, that feels good too. And you probably can't get that nowadays anyway. A lot of our deals are 55 by the time you add in deal costs and CapEx. So
Yeah. What do you guys underwrite for capital reserves? Is there a
capital
certain
reserve like 250 per unit
per unit?
per
Okay.
year. Yeah.
Makes
And
sense.
all the deals are pretty conservatively. They have a pretty detailed CapEx plan, whether or not we're doing interior value add program.
Yep.
And of course, it depends on the deal too, right? We're looking at a lot more new deals that are like 2019 and newer. And in our past, a lot of it was, 1980s and more value add oriented deals.
Got it. So you've been through the cycle of building a pretty large company. So I always like to get people's perspective like yours for the different stages of growing a real estate investing company. So take the hat on from, the version of you that was just starting that company. You and your partner decided on the plan, you decided on the vision, and you started, taking action. What were the first three kind of hurdles that you had to overcome in order to reach where you are today?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Wow, there's a lot. Let me try and put myself back there. The a key thing is capital,
Yeah.
like and I think that's a very important thing. It depends what you want to do. Some folks are really more of lifestyle investors. They don't want a big team. They don't want to really scale. They just want to cover. They want to replace their W-2, and they want to be financially free. And I love those. That mentality is wonderful. But if you're building a scaled out play, I think you really have to think deeply about your capital. Like we kind of migrated into a GP fund. So that's a general partner fund. That's where the partners put in money into that fund. So we have skin in the game. And then we put other LP capital alongside of us. And that'll take 10% of every deal minimum. So that's one way to do it. But some of that's, so if you do that, that's one way to do it. But then also like where's your capital going to come from after that? Do you go to high net worth? Do you go to ultra high net worth? Do you go to sort of that mass affluent, retail crowd that has investable cash? They're still accredited, but or do you go with JVs on every deal that'll take 90% of the capital stack? So I think I'm going to pause there because we like that's a whole episode.
Yeah.
Getting your capital in place is huge. And then I think that the second big thing is, are you vertically integrated or not? And building vertically integrated, I think, has a lot of advantages.
Yeah.
Especially some capital just wants to deal only with vertically integrated teams.
Yeah.
Because they feel there's a little bit more alpha there. But I'll say, looking back in 2011, building that company, a lot of your energy goes to building your property management, building your construction management.
I was going to say, which one's harder, the construction side or the property management side?
Oh man,
Building the team around it at least.
They're probably. I would tip the hat to property management. It's so difficult. It's because a lot of in the industry, it's 50% is considered for retention rate. So if you retain 50% of your people, that's considered very good.
No shit, I did not know that.
Some groups are like 75% turnover every year.
That is insane for property management companies.
Yes,
wow.
Yes. And so you become, in essence, like a staffing company. That's why culture, when you build a property management team, is huge, because more tenure you have, you want people just, so pumped up about staying with your team.
Yeah.
And then to do that, you have to have a great culture, but you have to be growing as well. Because if
Yeah.
you don't grow, people are like, well, I don't want to sit around at a 4,000 unit property management company. I want to go to someone who's going to go from 4 to 40.
Right.
And that's the tear that we're on. And that's why in our property management business, we're having a really good time keeping folks because they see this is going places.
Nice. Yeah, being
But
able to paint that picture, paint the vision of where you're going, is so important for all levels of the organization. And yeah, I mean, property managers, we don't have a property management team, but we, hire individual property managers for our parks. And there's two parks in Eastern Washington that we just were just having a hell of a time finding a good property manager. And we almost sold the properties because we were having that difficult of a time. We had it under contract at one point, and then interest rates changed, and it didn't end up going through. But we finally found a good property manager, and it completely changed our opinion on the properties. We're like, these are the best properties ever because we just had a
yeah,
good property manager. It's night and day when somebody's managing well versus when they're not. And so, yeah, I understand 50% turnover. That's rough, but I understand. It is probably it is one of the most important aspects of your company is just building a good management team and making sure that they're leasing properties, they're leasing units quickly, they're doing turnover quickly. Yeah, so it is a task for sure building up that team.
yeah, it's fascinating, right? You have someone who's making, let's say, $75,000 base, and maybe sometimes above in a very large property. Let's call it a 300 unit property. That property might be worth $50 million. So they're the CEO of that business.
Yeah.
And so we try to pay toward the top range and try to get the best talent. But you have someone at that level, making decisions at a $50 million asset. Now there's a lot of eyes there. There's an asset management team that has oversight and regional managers and RVPs, and there's layers. But the really, to your point, man, that key person, the linchpin, is the CEO of the business, which is the property manager.
Yep.
So
awesome, man. So what is your guys' crystal ball saying about the next 3 years for your company and then also for the economy?
It's changed a little bit. I mean, we're in an election year. I've been talking a lot about this with some smart people, including some of my partners in the business. And, I do think that if I'm not going to get political here, but I do think if Trump wins, there's a lot of pent up energy still in the economy. It's an incredible force. And I think it's going to rage.
Yeah.
And I think that's going to be a very pro business administration. It was already 2016 to 2020. We got Opportunity Zone. We got a lot of different things that helped real estate folks. And I don't see why that'd be any different now. So I'm sort of like changing some of my mentality. I think we thought we were wrong a little bit. I was wrong, that I thought there'd be a little bit more distress by now. But I think people are extending with their banks and they're kind of like delaying some of the pain. But pricing's come down. So I do think it's still a great time to buy. I just thought there would be a lot more transaction activity by now and more people pulling the cord and getting out.
Yeah.
So my crystal ball would be, if I had one, we're not market timers, but I do think the next 3 years, U.S. economy is going to do really well, at least the next 2 years. That's my view.
Yeah. Yeah, that seems to be the prevailing sentiment, which is funny because for so long people were kind of doomsdaying, saying that we're heading to the worst crash ever. And that crash never really materialized. I mean, it did go down for a bit, but it didn't crash. And now people are saying they're bullish on the future. It's interesting because nobody really has a crystal ball. It's you never know actually what's going to happen.
They don't, but look at the productivity. Some of the X factors out there and productivity increases. Obviously, AI is the biggest one.
Yeah.
So what if AI makes people 10x more productive?
Yep.
Which it will over time, but just how quickly does that happen?
Yeah.
It's going to be like, some people say it's like the internet. Well, the internet, look at Seattle. Just look at Seattle. Look what Amazon did and helped bring Seattle back. And Microsoft was there, right? But I lived in Bellevue, like I told you. And just how many millionaires are minted off of Microsoft and Amazon?
Technology, yeah.
Amazing.
Yeah, AI is fascinating to me. I like I dabble with like ChatGPT and stuff, but I'm very interested in how that's going to affect all companies, all the entire economy, every different sector, how it's going to be affecting them, the different efficiencies that we're going to have in the economy. I do think that's going to be a huge boon once it really, really takes off. I don't know enough about it, so I'm not going to put my foot in my mouth here, but it is
No,
definitely
thematically, I
interesting.
think you're absolutely right. So
Yep. All right, man. So that does wrap up the initial section here. It's time to jump into the quick question round. Are you ready?
yeah, let's do it.
Cool. Starts with education. It could be any form, could be movies, books, podcasts, YouTube channels, whatever. I just need two recommendations, one for general life wisdom and then one for real estate.
Oh, general life wisdom. I think from an investing standpoint, I like to say the Buffett shareholder letters, like read all, 50 plus years of them. They're hard to get through, but there's so much
Is,
wisdom and it goes through cycles and it's funny too, it's excellent.
is
So
there a book out there that kind of has them compiled?
yeah, there's a you can buy on Amazon. I know I don't know what year it goes up to now but it used to be you can get the 50 years
That's
uh,
cool.
all in one book, and it's thick.
Yeah.
So do it with a reading club because otherwise you're gonna with some people that you respect and just like read them together and just discuss. That's what we did. It was really helpful.
Cool. So that was that general life wisdom or real estate?
I would say that's investment wisdom. General
Okay.
life wisdom, I would say the gospel.
Okay.
Um, and then yeah, that's just evergreen. It's always got something new in there for if you just come back to it in a different time of your life, you're gonna get a different message. That's
Always
all
solid.
wonderful.
Yeah.
And
I
then
always like the book of Proverbs. Just little
yeah,
snippets of wisdom, kind of easy to digest.
no doubt. Real estate. Recently I read the Raising Capital for Real Estate by Hunter Thompson.
Hunter Thompson. Yeah.
I didn't think it was gonna be as good as it was. It was excellent.
Yeah. Yeah.
So
I listened to that book in the sauna. So I don't
mhm.
remember every piece because whenever I'm in the sauna, I'm always just sweating
Zoning.
balls and I can't
Yeah.
focus. But yeah, that is definitely a good recommendation.
Yeah.
All right, next question is for your younger self. We already kind of did this a little bit, but let's go back to the version of Dan who had no experience in real estate. He was just, I can't remember what year you said, 20 years ago when you were just buying that first duplex. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would say more quickly, invest in a market that's going to be at your back. I got stuck for a long period of time up in New York in an area that wasn't really growing.
Mm,
Just really like life is short. You don't want to. You can't really you can't fight that market. Like the market forces need to be at your back because
yep,
you don't think you're smarter than the prevailing stuff that's happening around you.
yep,
So be in a growth area and then get excellent at that growth area. Like know every little piece of that pocket that you're in, and then that's when you're going to have some alpha.
yep, yeah, 100%. There is competitive advantage to just focusing on one specific area. It took me a while to realize that. I started buying everywhere, all over the country.
Mhm.
But focusing on one area, getting the economies of scale with your management team is definitely beneficial. Which leads us to the next question. This is about the U.S. talking about metros. There's a ton of them out there, a lot of good ones. What is your favorite metro that you're most excited about investing in today?
Well, it's where I'm sitting. It's Austin, Texas, and a lot of people are short on Austin right now, that's
I've
okay.
heard that. Yeah.
Yeah, they're worried about supply, and we are too. Obviously, we're investors, and we're right here, so we see and we have CoStar. We look at all the construction reports. There's a lot of inventory coming. However, just look at the past. Austin as a growth machine and its economic growth has been amazing, and then that means population's coming to go fill those jobs. So before you know it, in the blink of an eye, the supply imbalance will be absorbed. All these units that are here, people are going to be like, "Wow, we're back in balance." And then soon enough, now that permits have decreased, not as much as they have in other metros. So Austin still is pulling permits, but they're going to be like, "Wow, it's in balance." And someday it's going to be like, you know what? There's not enough supply. The demand is too strong. Because look at just yesterday, Austin was in the news because Musk is moving his two more companies, one to Austin, that's X, which is Twitter, right? And another one, SpaceX, is moving to really, deep South Texas, in Brownsville.
Hmm.
So two more people, and you got to think they're going to keep some people on the West Coast. Obviously, it's engineering, capital of the nation, the world, in terms of software development, but they're going to move people here, jobs here. Samsung is here. The defense industry is here. Real estate's a big deal. UT is one of the biggest what do you call that? Foundations in the U.S. in terms of college, endowments, I should say. That's what the word I'm looking for. So much money. It's a research center. UT. Austin's one of the best regarded schools in the nation. I'm maybe 5-minute walk from there.
Oh, nice.
So this is so much pressure. And Tesla, when they announced Tesla, it was supposed to be 5,000 jobs at the Gigafactory. Now they think it's going to be 60,000 jobs.
Wow, that's a big jump. They really underestimated that one.
And that's not whispers. That's in the press now that they're actually coming out and saying that. So, and then these things have spin-on effects. If you're a supplier, you got to be next to Tesla. And if you're a supplier of Samsung, you got to be next to their giant, chip fab plant that they have going up there and a little bit north of us. Yep. Anyway, these are just some things, right? They're, talk about a dynamic economy, talk about Austin.
Yep. Follow the jobs. That's the best way to invest for sure. All right. Next question is about lessons learned. Not every deal we get into goes the way we expect it. A lot of times a wrench is thrown into the mix and we get to learn a lesson. So what was a deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
It's a deal in Houston. It happened to be very old, typically at that point we were buying like 80s and newer, but we bought this, we thought we had a good deal on a 60s deal. And you have to really, really, and it was a large unit count. So you have to really, really understand, do you have the right CapEx dollars? If you're doing an interior rehab program, are there enough
asbestos abatement, all that kind of stuff?
Yeah, there's so much stuff that goes into it, and it became, cash. It just sucked cash. And it wasn't, so I would, if I could do that one over, I just wouldn't do it.
Yeah.
I wouldn't do it differently. I just wouldn't do
it. Might as well do easier projects, right?
Yeah, exactly.
That's funny. All right. It does take money to make money in real estate. That is 100% true. You mentioned yourself, capital is the first place to start. So what is your favorite way to raise capital in today's environment?
I would say in general, just like be mission focused, really go deep on relationships. Something I've gotten had to get a lot better at because I've been very internally focused building out our teams, and there's only so much juice you have. But I really think it's like be mission oriented. So if you have a good deal, you have almost like a moral obligation to show that to people that are in your network. And think of it that way. Like I have a mission to help people steward their assets.
Yep.
And look at it from that standpoint, and then go deep on relationships. And these fund to fund folks, I'm sure you're familiar with it, being in the industry, but it's been a very nice channel for us to build out great relationships there too. So fund to funds are people that are syndicating, typically for other people's deals, right? We're the GP, they're coming in, taking $1 million piece of our deal, and then they're farming that out and raising it through their network. And that's been pretty cool and some of these folks they're all like really just excellent people.
Yep.
So it's been fun to get to know them.
Yeah, relationships are definitely everything. I read a book a while ago. Now I think it's called Never Eat Alone or something like that. But the synopsis of the book is literally just the title. It's just Never Eat Alone. Whenever you're going a place, if you're flying to, do a DD trip or something like that, hop on to Facebook, find a real estate investing club, type in, hey, who wants to meet up for lunch?
Right.
And then just, meet up with people, start those relationships. So I like that concept because you're right. Relationships are everything in real estate. And it is obviously the best way to raise capital is meeting people face to face.
Yeah.
All right. That leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Yeah, they can. I give out my cell phone. A couple people have hit me up off podcasts. So, I'm always down to exchange ideas and see if we can maybe serve you as an investor or property management partner. So my cell phone's 629-1808. And or atxacquisitions.com has a lot about our current deals, our fund, and our track record. And on LinkedIn, I'm trying to be very active on LinkedIn and add value to folks. So check me out on LinkedIn, Daniel French, and I think I'm pretty easy to find there. So yeah, hit me out, message me, and let's talk.
Perfect. I'll put those links and in the show notes. So if you guys want to reach out, just click the little more in the description. It'll pull down that full description. In there, you can find Dan's link and email. All right, man. That wraps it up. Thank you very much for hopping on the show.
That was fun, man. Thank you.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review on Apple or whatever you're listening to this on. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at Gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.